Global market attention is currently focused on a single room in Washington. Federal Reserve interest rate decisions are the biggest economic engine today. Every comma in Fed statements can move trillions of dollars in seconds. We are living through a critical transition moment for the American investor. Recent inflation data, the CPI, has become the total focus of analysts. The Consumer Price Index is the compass that dictates the pace of rates. If inflation comes in higher than expected, the dream of rate cuts fades. This creates immediate pressure on Treasury yields, known as treasuries. In the short term, volatility is the rule whenever the Fed speaks out. The stock market reacts instantly to any sign of a hawkish stance. If the authority signals high rates for longer, corporate valuations drop. This happens because the cost of capital rises and household consumption falls. Service inflation in the United States has proven to be extremely resilient. Unlike goods, services depend on wages that continue to trend upward. As long as the labor market remains hot, inflation will struggle to fall. The Fed monitors the payroll report as strictly as it monitors grocery prices. The impact on American fixed income securities is direct and very deep. With rates at current levels, 10-year Treasury notes offer attractive returns. This drains liquidity from global markets and directs it toward U.S. safety. The dollar strengthens, creating a logistical challenge for all other currencies. For the long term, the sustainability of American debt comes into play. Elevated interest rates for too long increase the cost of servicing public debt. This could limit the government's investment capacity in the coming years. Investors must look beyond the next quarter to understand this real risk. Monetary policy decisions do not happen in an isolated vacuum. There is a direct correlation with capital flows in emerging markets. The difference between domestic and external interest rates dictates exchange flows. If the U.S. does not cut rates, the rest of the world has no room to reduce. The short-term perspective suggests a stance of cautious waiting. No one wants to position themselves aggressively before official data is released. Liquidity usually decreases hours before the announcement, increasing costs. Small variations in inflation data can cause large opening price gaps. In the stock market, the tech and real estate sectors are the most sensitive. Growth companies need low interest rates to justify their current prices. Meanwhile, the real estate sector suffers from direct increases in mortgage rates. The dream of homeownership for many Americans is paused by high rates. The Fed seeks a soft landing where inflation falls without causing a recession. It is a delicate balance that few central banks have achieved in history. If they tighten too much, unemployment rises, too little, and inflation returns. This is the central dilemma defining all current economic policies. The interest rate futures market already prices in different year-end scenarios. Professional investors use probabilities to adjust their portfolios accordingly. We see real bets on when the first interest rate cut will finally arrive. Any change in these bets alters the price of nearly every global asset. In the long run, structural inflation may be higher than in the last decade. Factors like deglobalization and the energy transition are inflationary. This means the neutral rate may have permanently risen in the U.S. Investors waiting for 0% interest rates may be stuck in the past. Foreign exchange is the first line of shock for monetary policy decisions. A tighter central bank attracts capital to the dollar, the ultimate safe haven. This makes commodities priced in the American currency more expensive globally. The ripple effect hits everything from oil prices to the cost of shipping. Official communication is just as important as the rate decision itself. The tone used in press conferences defines the market mood for the month. One must be firm to anchor expectations, but gentle to avoid panic. Experts dissect every word looking for clues about the next steps. Future outlooks indicate that volatility will be the new market norm. There is no longer a clear and predictable path as seen in previous decades. Data dependency makes the economic landscape very reactive and unstable. Each new employment or inflation report restarts the betting cycle. For long-term investors, geographic diversification is a key defense. Being exposed to only one currency or market is an unnecessary risk. American rates call the tune, but not all assets dance the same way. Understanding asset correlation is what separates profit from real loss. The government bond sector, the treasuries, is the world's risk-free base. When this base moves, the entire building of global finance shakes with it. Investors seek protection in these bonds during times of great uncertainty. But even treasuries suffer price swings during periods of rising rates. Individual investors should avoid trying to second-guess the Fed's moves. Focus should be on strategic allocation according to your risk profile. Trying to day-trade inflation data is an extremely high-risk strategy. High-frequency robots react milliseconds before any human can intervene. Core inflation, which excludes food and energy, is what the Fed watches most. It reflects the real trend of prices in the US economy over the long term. If core inflation is falling, there's hope for the equity markets. If core persists, monetary tightening will remain the primary tool. The impact on consumption is visible through the cost of revolving credit. American families are starting to feel the weight of real indebtedness. This could lead to a GDP slowdown in the second half of this year. The authority monitors consumption to avoid a deep and painful recession. Interest rate decisions in the US are the sun of the international financial system. All other economic planets orbit around this benchmark base rate. Clarity in inflation data will bring much-needed peace to global markets. Until then, caution and technical analysis remain the best strategies.
Have you ever stopped to think that the videos you just watched with flawless scripts and engaging narrations might have been created by someone who never even touched a camera or a microphone? There is a new digital elite profiting heavily behind the scenes of YouTube and social media, building massive channels without ever showing their faces or spending thousands of dollars on equipment. While most people are frozen by the fear of being on camera, these individuals are using the hidden power of artificial intelligence to generate automated content that works and earns for them 24 hours a day. The secret to dominating this game isn't about having a famous face. It's about knowing how to command the right tools to create scripts, voices, and visuals that magnetically hold the audience's attention. I've gained access to a strategic method that reveals the exact roadmap for you to build your own invisible digital empire. Mastering AI to turn clicks into a real source of income. It is the perfect opportunity for those seeking financial and geographical freedom without having to deal with the pressure of being a public figure on the internet. Best of all, you can seize this opportunity right now for a symbolic price. The complete training is under an exclusive promotion, dropping from $97 to just $17. This is your passport to unlocking the knowledge you need to start your professional journey with AI today. Click the first link in the description to secure your spot while this discount is still active.
Investors must understand that high rates change the rules of valuation. What worked with cheap money no longer works in the current scenario. Selecting profitable companies has become more important than chasing hype. The market is separating those with cash from those who rely on debt. Short-term rates influence the yields on savings and money market accounts. This creates direct competition with the stock market for available capital. Many prefer the security of fixed interests when uncertainty is high. This movement out of stocks puts downward pressure on share prices. In the long run, technology may help reduce structural inflation. Automation lowers production costs and increases overall global efficiency. But this effect takes years to be felt in the official price index. The Fed works with the now, while technology works with tomorrow. Trust in institutions is the foundation that sustains the value of the dollar. If the market loses faith in the Fed's ability, financial chaos increases. This is why transparency in inflation reports is taken so seriously. The credibility of the US currency depends on strict price control. The commercial real estate landscape faces a massive refinancing challenge. A lot of debt matures soon and will need to be renewed at much higher rates. This could generate a credit crisis in American regional banks. Attentive investors monitor these maturities as a major warning sign. The resilient labor market is a double-edged sword at this moment. It guarantees consumption but also prevents service inflation from falling. The balance between full employment and price stability is the great challenge. It has never been harder for economists to predict the next move. Cash flow analysis becomes the primary tool for the modern investor. In times of high rates, companies that generate actual cash are worth much more. Profit promised 10 years from now is discounted aggressively today. Focusing on the financial present is a way to mitigate market risks. Commodities, such as gold and oil, react inversely to a strong dollar. If hedges rise, the dollar rises, and commodities tend to face pressure. This helps control global inflation, but hurts commodity-producing nations. It is a complex gear system where each piece influences the other's movement. Global liquidity is being tested by quantitative tightening programs. The Fed is not just raising rates, it is also removing money from the system. This makes the market more sensitive to any unexpected credit shocks. The era of easy money is definitively left behind in history books. Investors must be ready for rapid narrative shifts in the marketplace. One day the fear is inflation. The next the fear becomes a recession. Knowing how to filter the noise from the news is essential for sanity. Official reports are safer sources than sensationalist headlines. The inverted yield curve has been a historic warning sign in the US. It occurs when short-term interest rates are higher than long-term ones. Generally, this precedes a significant economic slowdown or recession. Tracking this curve helps understand what major players are expecting. The American banking sector is under constant watch by regulators. Interest rate risk management has become the main theme of meetings. Institutions that did not prepare for the hike are in a fragile position. This reinforces the need to invest only in rock-solid companies. In the long run, American demographics will also influence inflation trends. An aging population changes consumption and savings patterns over time. This affects the natural interest rate that the economy can support. The Fed considers these structural factors in its multi-decade projections. The financial market is a mechanism for anticipating future events. Today's prices already reflect what is expected of rates in the coming months. Surprise happens when the actual data deviates significantly from the consensus. It is in this divergence that the greatest investment opportunities arise. Keep your portfolio resilient to different interest rate scenarios. The stagflation scenario is the one most feared by global investors. In it, growth is low while inflation remains stubbornly persistent. Real assets and companies with pricing power are the best defenses. Financial education is your greatest asset in times of macro uncertainty. Understanding how rates affect your life helps you make better decisions, from car financing to choosing stocks for your retirement portfolio. Everything passes through the boardroom of the U.S. Central Bank. The American economy remains the locomotive of the developed world. If it slows down to fight inflation, the whole world slows its pace. It is a necessary price to guarantee the stability of purchasing power. Investors must be prepared for this journey of economic adjustment. Watch retail consumption data very closely over the coming months. It will show if the American consumer is finally losing momentum. If consumption falls too fast, the Fed will be forced to cut rates sooner. This is the chess game we are watching in real time right now. Technical analyses can help identify entry points in various assets, but it is macroeconomics that defines the direction of the main trend. Never fight against the trend dictated by current monetary policy. The saying, "Don't fight the Fed," has never been truer than it is today. Future projections for the dollar depend on U.S. fiscal health. High public deficits could, in the future, push inflation upward. This would require even higher rates to maintain confidence in the currency. The long-term investor monitors government spending with great care. Knowledge is the only tool that cannot be confiscated or taxed. Invest time in understanding rate cycles and how they create wealth. The greatest investors in history grew rich during moments of adjustment. Take advantage of volatility to learn and position yourself strategically. The future of U.S. investments will be defined by inflation management. We are in a new economic regime, different from the last 15 years. Adaptation will be necessary for those who wish to obtain above-average returns. Stay updated with reliable sources and real statistical data points. The transparency of the American financial system is still the world's best. Despite challenges, clarity of information attracts global capital. This ensures that even increases the market continues to function. Investors should value this structure when choosing where to put money. We conclude our technical analysis on the impact of rates and inflation. The scenario requires caution, but it also offers opportunities for the vigilant. The market rewards those who do their homework and analyze fundamentals. Stay tuned to the next data releases as they will dictate the pace of your capital. What is your strategy for protecting your portfolio from Fed volatility? Do you believe U.S. inflation is under control, or are we in for surprises? Comment your opinion, subscribe to the channel, and leave a like for more. Your participation helps bring serious financial information to more people.